In 1985, an Amish woodworker in LaGrange County, Indiana, retired at 62 with a paid-off farm, no Social Security, no IRA, and zero debt. He used 20 hacks his community has practiced since the 1730s. Number 12 was so dangerous, bankers spent decades trying to legislate it away. Number 3 has been outside IRS reach since President Johnson signed the exemption in 1965. Number 1 built generational wealth before the Federal Reserve existed. These 20 hacks built the most quietly wealthy community in America, while bankers spent 50 years burying them. Subscribe because this changes every dollar you spend. Number 20, the community barn raising. In Lancaster County, Pennsylvania, when an Amish farmer loses his barn to fire, the entire district arrives within days. No insurance adjuster files a claim. No contractor submits a bid. No bank loan is applied for. 200 men arrive before sunrise with lumber, nails, and hand tools, and by evening, a new structure stands where the old one burned. The Amish call this Gelassenheit, the yielding of individual need to community strength without expectation of repayment. The Elizabethtown College Young Center for Anabaptist and Pietist Studies estimates that a typical Amish barn raising delivers the equivalent of $50,000 in skilled construction labor in a single day, at no cost to the family. In modern America, rebuilding a barn requires a licensed contractor, a building permit, an insurance claim, and often a bank loan. The Amish do it in a day. No invoice follows. Number 19, the Amish Aid Society. In Holmes County, Ohio, when an Amish family faces a catastrophic medical bill, the Amish Aid Society covers it. No monthly premium is charged. No deductible is required before coverage begins. No claim is denied for a pre-existing condition. The community pools contributions from every member district and distributes funds based on demonstrated need, reviewed by church deacons. According to the Young Center for Anabaptist and Pietist Studies, Amish communities pay an average of 70% less per medical procedure than insured non-Amish Americans because they negotiate cash prices directly with hospitals and pay immediately. The system has operated continuously since the early 1900s. The average American family now pays over $22,000 a year in health insurance premiums and out-of-pocket costs. The Amish Aid Society charges its members nothing. The financial industry studied this arrangement for a century. It cannot replicate what it cannot monetize. Number 18, no-interest community lending. An Amish farmer in LaGrange County, Indiana, who needs capital to buy a new piece of land, does not walk into a bank. He sits down with the bishop and the deacons, explains his need, and the community lends from a shared fund at zero interest. There is no mortgage document, no credit check, no origination fee, and no variable rate that adjusts when the Federal Reserve changes course. Repayment terms are set by the community based on the borrower's circumstances. Amish mutual aid lending funds have operated in this form since the first permanent Amish settlements in Pennsylvania in the 1730s. A standard 30-year mortgage at 7% interest costs more in total interest than the original purchase price. The Amish lending fund costs the borrower nothing beyond the principal. The Federal Reserve cannot regulate what never passes through a bank. Number 17, cash-only purchasing. An Amish family in Geauga County, Ohio, does not carry a credit card. Not because none has ever been offered, because none has been accepted. The community operates on physical currency. Every purchase is made with cash in hand. Every bill is settled on the day it is due. When the envelope runs dry, spending in that category stops. No exceptions and no borrowing from next week. According to the Federal Reserve's Survey of Consumer Finances, the average American household carries $7,951 in credit card debt at an average interest rate of 22%. That household pays approximately $1,700 a year in interest alone for the privilege of spending money it does not yet have. The Amish family pays nothing in interest. Your great-grandmother called that common sense. The credit card industry calls it a missed opportunity. Number 16, the deep pantry. In every Amish household in Lancaster County, the cellar holds at least 6 months of food. canned tomatoes, pickled beans, dried corn, preserved meat, and sealed jars of fruit-lined shelves from floor to ceiling. The pantry is not a crisis response. It is a financial strategy. A family that can feed itself for 6 months from stored provisions does not panic when a paycheck is delayed, does not go into debt when food prices spike, and does not shop out of desperation in any season. Amish families in Pennsylvania have maintained deep pantries continuously since the 1700s, treating fall preservation as a core household financial obligation that sits alongside rent and fuel. The modern American household holds an average of 3 days of food on hand. Grocery chains prefer it that way. 3 days of food means 3 days until the next purchase. Number 15. The Amish second-hand economy. An Amish family in Holmes County, Ohio, furnishing a new home does not visit a furniture store. They attend the community auction, buy used goods from neighbors who are moving or downsizing, and accept hand-me-downs from extended family without embarrassment. A kitchen table that cost 50 cents at auction would have cost $40 new. A set of cast iron cookware that cost $2 at a church rummage sale would have cost $90 retail. Nothing leaves the community. No retailer takes a markup. No bank card collects a transaction fee. The modern American resale market, driven by platforms like eBay and Facebook Marketplace, generates over $50 billion a year. The Amish have been running the same system for 300 years. No one charges a listing fee. No algorithm decides what sells. Number 14. Hand tool craftsmanship. In LaGrange County, Indiana, an Amish craftsman builds furniture, barns, and household goods using hand tools his father passed down and his grandfather sharpened before him. No electricity bill arrives at the end of the month. No equipment lease payment comes due. No bank loan finances machinery that depreciates the moment it leaves a dealer's lot. Amish workshops in LaGrange County produce over $200 million in furniture and construction goods annually, according to the LaGrange County Economic Development Corporation, using tools that carry no financing costs and no monthly payment. The average American contractor finances tens of thousands in equipment at any given time. The Amish craftsman carries a debt of zero. His grandfather's plane cuts true. Number 13. The below-market family farm transfer. In Holmes County, Ohio, when an Amish farmer retires, he does not list his land on the open market. He transfers it to the next generation at a price the bishop and the community agree is fair, typically well below appraised value. This keeps productive land inside the community rather than allowing it to be absorbed by institutional investors. The National Agricultural Statistics Service reports that average American farmland now sells for over $4,000 per acre. Institutional firms have acquired tens of millions of American agricultural acres in the past decade. The Amish farmer transfers his 80 acres to his son for a price they can both honor. No outside bank holds a lien. No investment portfolio captures the gain. The land stays in the valley where the family planted it. Number 12. The Bishop-mediated business loan. An Amish entrepreneur in LaGrange County, Indiana, who wants to open a woodworking shop, does not write a business plan for a bank loan officer. He presents his idea to the bishop and the deacons, who assess his character, his skills, and his realistic prospects. If the community approves, capital comes from a shared fund at zero interest with repayment terms matched to the enterprise's actual income. The Federal Reserve built a credit scoring system that claims to predict creditworthiness. The Amish assessed character directly for 300 years before the credit score existed. A character-based system charges no origination fees, requires no credit history, and involves no algorithm. It requires one honest conversation with people who have known you since the day you were born. Number 11. Off-grid utility independence. An Amish family in Geauga County, Ohio, does not receive an electric bill. The community rejected connection to the public power grid in the early 20th century, a decision upheld by Church Ordnung across every settlement in North America. Energy needs are covered through propane, natural gas, diesel tools for specific shop equipment, and increasingly, solar panels on barns managed within the community. The average American household now pays over $1,500 a year in electricity costs, a figure that climbs every time a utility files a rate increase with a state regulator. The Amish household pays that rate to no one. Over a 40-year working life, that difference compounds quietly into a paid-off farm and a retirement the Federal Reserve had no part in building. First, pattern break. Here is where the Federal Reserve loses control. Every practice on this list keeps money moving inside the Amish community. The Federal Reserve cannot influence a lending rate it does not set. It cannot regulate a mutual aid fund it does not insure. Its entire toolkit requires that money flow through the banking system to have any effect. The Amish system was designed before the Federal Reserve existed. It has operated without interruption. Through every financial crisis, the central bank was created to prevent, and there is logic to the exemptions the government eventually granted them. The Amish have never once defaulted on a community obligation in their entire history in North America. The American banking system cannot say the same. Number 10, the Social Security exemption. In 1965, President Johnson signed the Social Security Amendments. The Amish petitioned for a religious exemption and received it. An Amish worker who files IRS Form 4029 is exempt from paying Social Security and Medicare taxes for their entire working life, provided their community cares for them in old age through mutual aid. The exemption is permanent and codified in federal law. A worker earning $60,000 a year pays $3,720 annually into Social Security and Medicare. Over a 40-year career, that is nearly $150,000 in worker contributions matched dollar for dollar by an employer. The Amish worker keeps both shares inside the community. The IRS granted the exemption because the Amish demonstrated they had never needed the program in the first place. Number 9. The Self-Insured Livestock Fund. In Pennsylvania Amish settlements, when a farmer loses his herd to disease, the district covers the loss. No commercial policy is purchased. No adjuster investigates the claim. No premium is set by an actuary in a distant office. A shared fund contributed to by every farm household distributes payments based on losses verified by church deacons who know the land personally. The American farm insurance industry generates over $16 billion in premiums annually. Amish farmers pay into that system nothing. They pay into their community everything. The system works because farmers with shared risk have strong incentives to report losses honestly and manage their herds carefully. Commercial insurers must pay adjusters and outside investigators to achieve what Amish deacons achieve through a lifetime of shared trust. Number 8. The Amish apprenticeship economy. In settlements across LaGrange County and Holmes County, young men do not attend trade school and take out student loans to learn a skilled occupation. They apprentice directly under a master craftsman from the community, working alongside him from age 14 until they are ready to work independently. The skill transfers without tuition, without debt, and without a government-issued certificate. The result is a generation of carpenters, blacksmiths, furniture makers, and construction workers who enter the workforce with zero educational debt and complete mastery of a trade. The average American college graduate now carries over $37,000 in student loan debt entering the workforce. The Amish apprentice carries none. He carries a set of tools and the knowledge of how to use every one of them. Number 7. The closed Amish supply chain. In LaGrange County, Indiana, an Amish furniture maker sources lumber from an Amish sawyer, hardware from an Amish supplier, and sells through an Amish auction network. Money enters the community from outside buyers and circulates internally before any portion leaves. The Federal Reserve has no mechanism to affect the velocity of money inside a closed supply chain. There is no interbank lending rate setting the cost of the lumber transaction. The modern American supply chain routes every purchase through multiple corporate intermediaries, each extracting a margin before any reaches the original producer. The Amish supply chain removes every intermediary. The producer keeps more of the final sale price. That was the whole design. The banks were never invited to participate. Number 6. Physical gold and silver savings. In Amish households across Lancaster County, Part of every family's savings is kept in physical gold and silver coins rather than in a bank account. The practice is legal and invisible to the Federal Reserve. In 1933, President Roosevelt ordered gold confiscated from American citizens at $20.67 per ounce, then repriced it at $35, instantly devaluing what had been surrendered. The ban lifted in 1974. Amish families maintained physical metal savings through both periods and every devaluation since. The metal charges no service fee and requires no minimum balance. It does not appear on any balance sheet a regulator monitors. It sits in a tin in a cellar that no algorithm has ever reached. Number 5. Direct cash sales without electronic platforms. An Amish family in Holmes County, Ohio, sells furniture, quilts, and vegetables directly to customers for cash. No credit card terminal, no digital payment reader, no electronic platform of any kind. Every cash transaction between buyer and seller produces no interchange fee for Visa, no data for advertising networks, and no transaction report for any federal monitoring system. The American retail industry pays over $100 billion annually in credit card interchange fees alone. The Amish roadside stand pays none of it. That structural advantage compounds every year a business operates without inviting any financial institution into the room. Second pattern break. Here is what the financial industry does not want you to know about people who opted out entirely. According to Pennsylvania State University Amish population research, the average Amish household carries less than $5,000 in total debt. The average non-Amish American household carries over $100,000. The Amish community loan default rate is effectively zero. The American credit card default rate in 2023 exceeded 4%. A community that does not borrow from banks does not owe banks. A community that does not pay interest does not lose wealth to interest. The wealth stays where the community put it. The Federal Reserve cannot tax what it cannot measure. Number 4. No participation in electronic banking networks. An Amish household in Geauga County, Ohio, does not have a checking account linked to any electronic payment network. In 2023, the Federal Reserve launched FedNow, a real-time payment system designed to process every American electronic financial transaction instantly. The Amish household is not connected to it. Every American who pays a bill electronically or receives a direct deposit paycheck is visible inside that system at every moment. The Amish farmer who deposits a physical check at a local bank is visible for that single moment and no other. The Federal Reserve's ability to track and influence a financial life depends on that life running through electronic channels. The Amish life largely does not. Number 3. The Amish mutual aid exemption from insurance regulation. Since the 1960s, Amish mutual aid organizations have operated outside state insurance commissioner authority and beyond IRS classification as insurance providers. The Amish Aid Society and Amish Church Aid are not classified as insurance companies under federal or state law and do not file the regulatory disclosures required of commercial carriers. An American who wants to create an equivalent community health sharing arrangement today must navigate Affordable Care Act exemption applications, IRS classification rulings, and state insurance board approvals. The Amish arrangement has been outside all of that since before most of those requirements were written. The IRS has never found a category that fits it. They stopped trying. Third pattern break. Here is the trick the Federal Reserve cannot replicate. You cannot legislate a community. You cannot write a regulation that creates trust between neighbors who have shared harvests and barn raisings for 3 generations. The Federal Reserve can raise interest rates, tighten credit, and slow the national money supply. None of those tools affect a community that does not borrow from banks, does not hold electronic deposits, and does not route transactions through the national payment system. The Amish did not design their economy to resist central banking. They designed it to serve their neighbors. Resisting the Federal Reserve turned out to be a side effect. Number 2, community-based wealth transfer between generations. An Amish family in Lancaster County does not use a probate court, a will attorney, or an estate planning firm to transfer wealth between generations. Land, tools, and productive equipment pass through community-mediated agreements witnessed by the bishop and recorded within the district. No probate fee, no estate lawyer's hourly rate, no financial institution collecting a percentage at the moment of passage. 3 generations of accumulated productive assets transfer intact to the next family. The family stays on the land its grandfather cleared without a bank holding a lien on the transfer. Number 1. Teaching financial discipline through community from childhood. This is the one that ties every practice on this list together. Amish children do not learn financial discipline from a curriculum or an app. They learn it by living inside a working economic system from birth. They watch their fathers negotiate community loans with the bishop. They observe their mothers managing the household cash envelope. They participate in barn raisings at 10, sit in on community auctions at 12, and apprentice inside a trade at 14. By adulthood, every Amish young person understands the full economic life of their community through 15 years of direct participation. They have never needed a financial advisor to explain compound interest. They watched it work in their community before they were old enough to vote. Your great-grandmother understood money this way. The bank spent 50 years making sure her grandchildren did not. Try one practice from this list this week. Just one. Set up a physical cash envelope for your groceries. Skip the card on your next purchase. Talk to a neighbor about a tool you both need and neither of you should buy separately. I tried the cash-only method for 30 days and saved $420 I had been losing to small purchases I could not recall making afterward. Not one of those purchases had improved my life. Drop the practice you are going to start in the comments. Tell me which one surprised you most. The Federal Reserve spent decades hoping no American outside those settlements ever connected what the Amish quietly built. The Amish kept it. Now you know what was buried.